You're chasing 7% yields in emerging markets, but withholding taxes could silently cut that in half. And if you're not calculating this correctly, you could be leaving thousands on the table every single year. Let me show you exactly what's happening to your money. If you're investing in emerging markets for those high dividend yields, you already know they're attractive. But here's what most investors miss. There's a hidden cost structure that's systematically reducing your net returns. Research shows that foreign dividend withholding taxes can reduce your yield by as much as 2-3 percentage points, turning a 7% yield into a 4-5% net return before you even factor in how you'll optimize it. Let's get specific. The IRS publication data confirms that foreign dividend withholding taxes range from 10% to 35%, depending on the tax treaty between the US and the country paying the dividend. That's a massive range. A country like Mexico might withhold 10%, while Brazil could withhold 15%, and some Asian markets could hit 20-25%. For example, the iShares MSCI Emerging Markets ETF, ticker EEM, has an average withholding rate of 15-20% across its entire portfolio of holdings. That's your baseline. Now let's put this in real dollars. Imagine you have a $500,000 position in emerging market dividend stocks, yielding 6% annually. That's $30,000 in gross dividends. But if the average withholding rate across your portfolio is 18%, that's $500,400 in foreign taxes withheld immediately, money that never hits your account. On a $500K position, that could range from $4,500 to $7,000, depending on the exact country composition of your holdings. But here's where most people think the story ends, and where they make their biggest mistake. They assume they can just claim a foreign tax credit and recover all that money. Not quite. The foreign tax credit calculation is extraordinarily complex, and it's subject to limitations that directly erode your benefit. The IRS has built in two major restrictions: the alternative minimum tax threshold, which can limit your credits in certain years, and passive income caps, which categorize your foreign dividends into specific limitation categories. According to IRS publication 514, excess foreign tax credits that exceed your limitation amount in a given year are either lost entirely or carried back 1 year or forward 10 years, but with strict, specific rules that create a complex tracking burden. Let me break down what that actually means in practice. On that $500K position yielding $30,000 in dividends with $6,000 in foreign withholding taxes, here's the real-world scenario. After filing Form 1118 and calculating your foreign tax credit limitation based on your U.S. tax liability and income composition, you might recover $4,800 of that $6,000, a 20% loss right there. This means your net yield drops from 6% to 5%, and your net return is $25,000 instead of $30,000. That $5,000 annual drag, whether it's lost credits or carried forward complexity, compounds to $50,000 over a decade. This is critically important right now for pre-retirees optimizing their portfolio structure within the next 12 months. You need to decide, should this $500K position live in a taxable account or a qualified retirement account? That decision alone can save or cost you thousands based on how these foreign tax credit rules apply to each account type. There's also a timing component that most investors completely overlook. The 2024-2025 tax law environment has shifted, and emerging market yields have been rising. If you're planning your account placement strategy without understanding Form 1118 mechanics, you could lock yourself into a suboptimal structure for years. So how do you actually minimize this? First, you need to calculate your precise foreign tax credit limitation based on your specific income categories. Second, you need to understand whether your emerging market position should be in a taxable account where you can claim credits, or a qualified account where the rules work differently. Third, you need a systematic approach to tracking Form 1118 carry-forwards so you don't lose credits to expiration. The full implementation checklist, the exact Form 1118 walkthrough, and the complete tax optimization strategy for $500K plus emerging market positions is in my book, The Compound Interest Bible. Link in the description. This is the level of detail that separates investors who recover thousands from those who don't. Stay informed. See you in the next breakdown.